In this video, champion trader Kevin Davey is actually reviewing one of my latest automated trading systems that I recently developed. And honestly, there is so many hidden gems and a ton of value in this video in terms of kind of information shared on what it takes to build great automated trading systems and trading bots. So he's going to review my strategy, scrutinize it. We're going to be putting it through some tests and hopefully it passes. We'll see. But once again, ton of value in this video. I know it's a lot longer than usual, but there's a lot of hidden gems. And please watch as much as you can because this is going to help you build better automated systems in the future. So grab your popcorn and enjoy. Okay, so I got Kevin Davey with me, guys, to review my strategy. So I'll give a little bit of a background on the strategy, why I created it. We'll go over some of the numbers in terms of the backtest results and then get Kevin's thoughts on what he thinks the strategy is. Is it good? Is it bad? Could it be better? Do I need to think of a new idea and get some of his feedback? So my goal with this strategy was to build an intraday long short NQ strategy. I didn't have one in my portfolio. You know, I have a lot of swing systems. I don't have any NQ or NASDAQ strategies right now. So I wanted to kind of get some exposure to that market, Kevin. And the reason why I wanted to do intraday is I wanted to try it. I know it's a lot harder. And I've said multiple times on my channel, and you have too, that it's really hard to build an intraday strategy because, you know, let's be honest, there's so much noise in the day, right? There's so much random price movement. It's hard to get repeating patterns in the day. But I wanted to try it and see if I could do it. So I think that I do have it, and we'll go over some issues with it at the near the end of the video. But basically, what the strategy is it uses Bollinger Band indicators to go long and short. Basically, if the price of NASDAQ starts trending up above the middle Bollinger Band where my mouse is, it's going to go long, and then vice versa. If it starts trending down below the middle band, it's going to be going short. There's no profit target. There is a stop loss and it will exit on session close. Okay. So I do usually, you know, when I test my idea, what I've learned from Kevin is to choose about 2 random years to do my initial test. So I took 2 random years and tested this idea. It did well. And then what I did was a walk forward test from 2008 until today. Okay. And that's, I think my data provider only goes back to 2008. So I wish I could go further back. But I think, Kevin, you said that usually 2008 is around a good time to start because that's when kind of electronic trading got started, right?
Yeah. I mean, on some of the ones like I'm not sure when the mini NASDAQ started, but I know like the mini S&P goes back to 1997. And that's always been electronic. But a lot of other markets, you know, they were pit traded, and then there was this transition, and a lot of the data kind of gets goofy. So what I generally recommend is 2007, 2008 usually should be enough data.
Perfect. Awesome. So what I did next was a walk forward optimization. And if you don't know what that is, that's basically where you optimize your parameters, test it for a period of time, and then re-optimize and retest going all the way until the end date. Okay. And it's great because it shows some out of sample performance, and it's just a better way of seeing if your strategy is robust. And obviously Kevin can go more into detail about that after, but that was the next step. I ran it from 2008 until today. So you can see up at the top here on my mouse, the actual first real trades weren't till 2010 technically, because it actually took the first 2 years of 2008 and 2009 as the optimization period, and then tested that from 2010 onwards. So that's why you don't see trades until then. So overall, it, you know, obviously from the net profit and the max drawdown, that ratio, it looks pretty good. Usually what I like to see is at least a 2-to-1 or 3-to-1 kind of ratio of that net profit to max drawdown. Usually if you're seeing that in a back test, and correct me if I'm wrong, Kevin, that's a good starting point where your net profit is double or triple that max drawdown to kind of as a first step to see if that strategy is decent. Obviously it's not the end all be all, but usually when I see that right off the bat, I'm like, okay, this is a good start. The next step, of course, is to use the average trade metric, which you like a lot too, Kevin. I think you said usually $50.
Yeah, after slippage and commission, you know, if it gets below $50, it's not saying it's a bad strategy. It just means there's a lot more uncertainty and things in live trading can go wrong. And all of a sudden, you know, if you have a $10 average per trade it doesn't take a lot of little hiccups to just wipe that out. So you got to be
Yeah,
careful.
definitely. And let's reiterate commission and slippage. So I made sure I added commission and slippage on this back test. So in NinjaTrader to do that, for commission, there's an include commission here under the setup menu. And it's so funny, Kevin, by default, NinjaTrader always unchecks this because I don't know why. I don't know why by default these should be checked and slippage should be enabled as well, right? And
Right. Well, yeah, TradeStation does the same thing. By default, it's always 0.
yeah,
And, I think it's just one of the little sneaky things the software people do to make all your back tests look better. And,
yeah,
better back tests make for happier customers usually. So I think
yeah,
that's why they do it.
yeah. So I had to check include commission. And there is a tip if you're new to NinjaTrader. When you first start off, you'll check include commissions, but your commissions will still show as 0 here. And what you actually have to do, I'll do it quickly, but if you go into your accounts and go to your sim account, which is your paper trading account or your backtest account, you actually have to right click and hit edit account and set a commission template. By default, it'll say none. So that's just a tip. If you click include commissions and it's still showing as 0, you got to make sure you set a commission template. And it could still vary. Like I use Interactive Brokers, Kevin, and their commissions are different from NinjaTrader, right? So I've actually gone and modified the values, but that's something to note. Now for slippage is different than TradeStation. So TradeStation, you set a dollar amount, right? You set, all right, you can do per contract or per trade. In NinjaTrader, it's based on ticks. So you don't set a dollar amount. So I've set 2 ticks on slippage, and this is from what I read from NinjaTrader, the definition, it's per order. Now, actually, one thing I want to go over is you in specifically in your course, you have a slippage Excel sheet for per each symbol, right?
Right.
On dollar amount. Do you recall for NQ how much it is off the top of your head, or?
It's 3 ticks for
3
that.
ticks.
So or $15. So because
Okay.
a full point in NQ, the mini NQ is $20. So yeah, I normally assume 3.
Okay. So technically I should rerun this with 3 if we want to be, scrutinizing as much as possible. So I'm going to do that right now. I'm going to set it to 3. Obviously we know the performance is going to be worse with that because for each trade now, there's technically an extra tick of slippage per trade. So I'll set that to 3.
Every round turn trade, that should be 2 ticks. So it should go down to 80 if I understand what Ninja's doing. Let's see.
Yeah, let's see. Okay, so I want to make sure my stop loss. Yep. Good. Okay. Let this run. And this is what it's all about. It's almost you pretty much want to beat down your strategy. I'm sure I've heard you said this, like you want to beat down your strategy as much as possible in the back testing phase because there's going to be a lot of just bad ideas. You think they're good to start off with and you're all excited, but you got to beat it down, right? And if it survives, great. But in this way, we're saving us money from running bad strategies, right?
Right. And it's amazing. Most ideas actually are good when you don't include slippage or commission, especially the slippage. I mean, commissions nowadays, usually are $5 a round turn or under. So that's not a killer, but slippage, especially in some markets, can be hundreds of dollars. So for example, earlier this year, I was trading lumber and I was entering with market orders, and eventually I just couldn't handle, $200 slippage per trade. It was crazy.
Crazy. Okay, so this looks odd to me. Did it went down by 9,000?
So it probably so it changed the best parameters, right? So it isn't a true comparison to the previous one because some of the parameters are probably different now, which is actually a really important point for people to know.
Okay.
Because a lot of people out there will say, well, hey, I'll just add slippage and commission later. When you think about it and you understand how it's optimizing, let's just say it's optimizing on net profit. Okay. And you don't do slippage and commission. Well, it might come up with a parameter set. Hey, that's the best one without slippage and commission. And it's going to be the biggest net profit. It's probably going to be the most number of trades too, because if you don't have trading costs, if your idea is halfway decent, you're going to want to trade it as much as you can.
Yep.
But when you add in slippage and commission, now those optimum values will change, and it will tell you really don't trade as much. That's usually what it does. I didn't see how many total trades you had originally, but
I can pull it up.
my guess is it probably is lower now because it's the optimizer is accounting for that extra slippage and saying, okay,
Yeah.
Jacob, don't trade as much if you're going to do that, which is
Yeah.
pretty
So
neat.
this one had 1422, which is
Okay.
with the 3. If I can go back to the previous one if I double click it.
It's 1428. I see that down at the
Yeah.
bottom.
Yeah.
So yeah,
Kevin's
so
right.
it took six fewer trades, which
Yeah.
Yeah,
Interesting.
so yeah, that's
Cool.
kind of exactly what I would expect.
You know what's interesting too, and this is specifically for Ninja people that use NinjaTrader. One thing that irks me is it says it has a max drawdown of 10,000, right? Which, you know, Kevin, usually you want to, there's different ways you can calculate in terms of required capital, but usually you want you want to do at least 1.5 times or higher than that in terms of reality, because what's the saying? Your next max drawdown could be bigger, right?
Yeah, I always imagine it as when you're driving your car and you look in your side mirror, your passenger side mirror, where it said objects in the mirror are larger than they appear. And so that's drawdowns in the future are always larger than they appear on the back test.
Yeah. So with NinjaTrader, what irks me, Kevin, is okay, it says 10,000 here. But if you look at these yearly, right? Like this year was 14,000. Last year was 17,000. This year it's 29,000, right? Isn't that weird? But when you go overall, NinjaTrader tells me, oh, it's 10,000, right? So what they're doing, I know what they're doing. I think they're taking the average of every year and averaging it out. But in reality, right, on a yearly basis, it could be much bigger. So when I'm calculating my required capital, I'm using at least 2 times higher. I mean, in this case, it's telling me I should use 3 times higher because this year it's 29,000, right?
That's
Isn't that scary?
really that's weird that they do that. Just as an alternative, like TradeStation in their reports, they actually give you 2 different drawdowns. They give you the max closed trade drawdown, and they also give you the max intraday drawdown, which both are important. But this, I've never seen something like this where, yeah, your max drawdown, because originally when you first showed me this strategy, I saw 10,000 max drawdown, and I was like, wow, that's pretty good.
Yeah.
Now I see that back in 2022, this year, it's had almost a 30,000, which to me is a lot more believable.
Yes.
So, wow.
So I think that's another trick they do to make it look better, right? So,
yeah.
Is NinjaTrader evil? Not really. I mean, it's just, they've decided to do that for whatever, but that's just something to take account. If you're using NinjaTrader, and you're running a walk forward test, the overall walk forward takes an average max drawdown. But if you look at a year-to-year basis, it can be bigger. Not always. I'm not saying always, but in this case, it is bigger. So honestly, what I would do is probably take the highest value and then multiply that by 1.5 at least, or 2 to get required capital. So anyways, that's something to think about. So we've reran the test with 3 ticks, right? Those are overall results. Obviously, we just talked about the max drawdown issue. The next step, Kevin, would be, all right, this is great. We want to run this through a Monte Carlo to kind of, jumble up the trades and see how it performs if it was sort of randomized. Is that correct?
Right. Yes.
Perfect.
Yes.
Okay. So I built a little tool that just prints the out of sample trades to the output inbox. And the reason why I did that is because one of the annoying things with NinjaTrader, you can't select the whole walk forward and select the trades. They've graded out for whatever reason. I don't know why, but it's just stupid. But anyways, I did.
Are you able to? Sorry to interrupt. Are you able to see an overall equity curve of that walk forward, or no?
No.
Okay, because that's something that I've talked about in my class. I like before you go to the Monte Carlo, yeah, it's nice to see the numbers, but it's also nice to see the equity curve because
Hmm.
uh, it becomes more of a subjective thing. But you've got to look at the equity curve and kind of imagine yourself, walking that path, and all of a sudden you're climbing this mountain, and there's this huge drawdown, which would be like this huge, valley or crevice or something that you
Yeah.
fall into,
Yeah, abyss.
and you gotta you really have to imagine yourself, would you feel comfortable with it, and I tell people that's a totally legitimate reason. Even if you have a good net profit, you might not like the equity curve, and you can dismiss it at that point for that. Or you can go on to Monte Carlo and see what it does. So
Yeah, I think I hate that I can't do that with Ninja. I mean, I can look at the numbers on a yearly basis, and we can actually see that. I mean, for the first 4 or 5 years, it just lost money, right?
right.
1 year, $182 in profit, right? And then yeah, it starts jumping up. And I mean, I know from a fundamental standpoint, Nasdaq didn't really perform that well until recently, you
Right.
know, since like 2015 onwards. So um, I sort of expected that to happen, but in terms of the system, like that's kind of scary to look at, to be like, hey, like, man, this didn't really start making money until 2015, 2014, right? Do I really want to
Right.
trade this? Right? It's doing now, like it's doing well now recently, but that could scare some people off, right?
Yeah. It's kind of, it looks like, and since you're Canadian, I'm sure you're a hockey fan, it looks like a hockey stick where it's flat for a number of years and then
Yeah.
kind of goes up at an angle. Um, that's one way the hockey stick looks. The other way the hockey stick looks is first it goes up at an angle, and then the last 4 or 5 years it just goes straight across. So you can
Yeah.
have either one, and either one you got to kind of be worried about, because it's not a perfectly smooth equity curve. Even the slope, there's obviously going to be jitters along the way.
Yeah. So that's something to think about. There's a ton of value in this video. Crazy. Okay, so um I mean, if I were to look at this equity curve, I'm just trying to like imagine it, taking these numbers on a yearly basis and plotting it out. I would still like it because it's showing strength now recently, which is good to
Mm-hmm.
see.
Yep.
It's getting multiple years of profitability, ending the year in profit. Um, Other than I guess 2019, but it does interest me because I've seen that before where you know strategies. I'm not saying it works every time, but if they recently start taking off, um, they still keep doing well. Now I don't have the math to back that up, but I've seen it before with some of my strategies, and I guess subjectively I would say, hey, like I've seen this before be successful. I would still like it. So, but that is a good point with the equity curve. Another reason to use TradeStation, I guess.
Although I don't use the walk forward tool in TradeStation, so I can't
True.
see an equity curve of my walk forward results until I actually create a version of the strategy using the output from the walk forward
Yes.
tool I use.
Yeah. That's um
Eh,
Stratop, multi-op.
yeah, it's called multi-opt. And it's something that a student of mine created about 5 years ago, or started to create. And it's an incredible tool, both for walk forward and for just rapid testing. So yeah, I
Oh,
use that all the time.
okay. And then what you're going to see next, guys, is Kevin's Monte Carlo Excel sheet calculator, which is, I'm going to be honest, the best Monte Carlo system I've ever seen in my life. And I've only seen three, but it's much better than NinjaTrader's version because in NinjaTrader, all they do is they show you a graph with a percentage success rate. Essentially, that's it. And it doesn't even work with walk forward. It only works on normal backtest. So it's literally unusable. But you guys can find the sheet in the description below. It's actually free on Kevin's website, and it's super useful for, um, breaking down your strategy to see, hey, is it good if you randomize the trades, if you randomize the orders, right? What if you had all the losing trades in one area? Like, would your strategy still survive, right? And Kevin, this is, if I recall correctly, step I want to say 6 in your strategy factory process.
Yeah, I think 6
Okay.
or yeah, because then 7 would be incubation. Yeah,
Yep.
I believe it's 6.
We'll
Sometimes I
see.
get confused too.
So what I've done is I've pasted the trades. So it's each individual profit or loss trade um, in column A here. And then what you can do is you can change your base starting equity and your stop trading equity. So to calculate these, basically what you can do, I'd say the most common way is to take the amount of margin required to enter a trade, and then you need to also factor in your max drawdown, right? So I'm going to be very pessimistic and take the highest max drawdown that NinjaTrader gave me, which was 29,000, right? And then we would take also the margin of trading NQ. Now this is an intraday strategy, so technically, Kevin, my margin is a lot lower
Right.
than swing trading. Usually swing trading NQ, it's like, it could range from anywhere to 20 to 25,000, right? To trade NQ contract. But when you're intraday trading, let me see here. I think it's like 900 or 800 bucks.
Yeah, depending on your broker, it could be pretty low. I know the span margin right now for NQ is actually 16,500. So you won't get an overnight margin at any broker lower than that, because that's the exchange minimum basically.
Okay, so let's do that. So you said 16,000?
16,500.
Okay, so we use that. And then we will, let's add the max drawdown, the highest max drawdown that we encountered. And then, well, usually actually before I even add the max drawdown, personally, and this is my personal rule, Kevin's might be different, I like to multiply this by 1.5 just to give me much more room in terms of, not essentially not blowing up, right? Or minimizing my chances of blowing up. I won't say I definitely won't blow up, but Kevin, there is other ways to calculate the required capital as well, right?
Right. And, part of the Monte Carlo simulator, what it does is you just give it one value and it will actually run, I think 7 or 8 different values increasing. So you would give it the minimum one, and
Oh,
then
okay.
it will actually do some bigger ones too.
Okay.
And that's how you get
You're right.
the
Yeah.
curve versus of like risk of ruin and, the return to drawdown.
Yeah. So I could do 16,500. I don't know if it'll
Yeah, I
increase
mean,
enough.
you know what? Why don't you? This would be interesting for people to see. Try
Sure.
it, and then try the stop trading equity of 16,500 also, just for kicks, because it'll
Okay.
show some interesting results when you go to calculate.
So the base and stop. And then number of trades in a year. So how I calculate this, a NinjaTrader gives us, what you could do is either you could take these values and calculate the average. NinjaTrader also gives us a metric of number of trades per day. So what I do, Kevin, is I just take, and I know it's based off 252, which is the amount of trading days per year,
Yep.
not including Sundays, or is it including Sundays? I'm not
It's
sure.
probably not including
Yeah.
Sunday, so the 252 would be accurate.
So 170, I'll round it down. So it's at 173. And this row 4 here, right? That's sort of like showing the Monte Carlo kind of your engine in the background to sort of take into account how many times it randomizes per simulation, right?
Yeah. So what it's going to do is it's going to run, I think, 2,500 different equity curves, and each equity curve is going to have 173 trades in it, unless it encounters a case where you run out of money,
Yep.
where your equity falls below that 16,500 in row 3, then it will stop trading.
Yep.
And it will be considered you're ruined. That's so, and you'll be able to see that in the ruin column. and it's just going through. This
Yeah,
isn't
that's
the
so cool.
fastest thing. I some people have given me ways to speed it up. I just never have done it, but it still works pretty good. I use this
It's
every day, pretty much.
same.
So what's
Yep.
interesting, and then I know you want to talk about a bunch of stuff with it, but look at that first line where it says 16,500. Your risk of ruin is 92%.
Mhm.
And you could say, wow, that, you know, that just tells you if you don't have enough equity to start with a trading system. I mean, we know this system made money. I mean, this is a pretty decent system, right? But if you don't start with enough money, you're almost guaranteed to be wiped out. And in this case, let's say your first trade, when it's randomly chosen, was a loser. Now you can't take that second trade because you said, hey, if I fall below 16,500, I can't trade.
Yep.
So right there, your risk of ruin is huge. And then, maybe you have a little bad streak after a couple wins. It falls below 16,500. That happens over 90% of the time. So this is, I don't use this tool for risk of ruin necessarily, but I use it more for the return to drawdown. But this is a great tool for people to use to figure out, like, hey, how much equity do I actually need to trade this system
Mhm.
without running into this getting wiped out? Because what I've found, most people get wiped out because they're not capitalized well enough. They just don't have enough money for what they want to trade.
That's right. And yes, you could trade this on micros technically, right? If say
Yep.
you didn't have 16,000 and you only had 6,000, right?
Right.
Well, you could trade this on micros. I don't know. The numbers would be reduced by technically a factor of 10, maybe
Right.
more. I'm not sure, but that is another option as well. But obviously your leverage goes down as well. So, but yeah, really good point. I one of the reasons why I love this sheet is, well, it gives you discipline on like, hey, what passes, what doesn't. And I love the risk of ruin too. I mean, technically the NinjaTrader Monte Carlo only shows you this. That's literally all it shows you. So that's why I hate it.
Okay.
It's like, man, this thing sucks. But yeah, so what it's done, guys, is it's taken the trades from our walk forward out of sample trades, right? The out of sample trades, and it's randomized them in order, and it's done that individually, 10 times here with different starting equities, right? So
Mm-hmm.
starting at 16 and increasing by, or I guess 4,000 per starting equity, and then it gives us different results for each of those scenarios, right? So basically, it's like it's trading the same system 10 different times in random orders of trades, right? And giving us metrics on, hey, is this going to pass or fail?
Right. And for each of those lines, it's running it 2,500 times. So really
Wow.
what you're seeing is 10 times 2,500. So 25,000
Yep.
equity curves total here. And the one thing that's important and why you do it is I forget, what did you have, like 1,200 trades or 1,400 trades in this back test? Well, when it goes to run the Monte Carlo, yeah,
Yep.
1422 was the number. When it goes to Monte Carlo, it's only picking 173 of those randomly to get 1 year. So, that's why you have to run it so many times, because you could pick, there'll be cases where you pick the worst 173 trades, and there'll be ones where you pick the best, but you run it enough times and you get a good feel for, what is the median values of drawdown and profit. And that's what this spits out.
Yeah. So the next main question is like, hey, is this strategy good? Is this something you want to run live? So I'll give my opinion, and then Kevin can have his too. And Kevin's opinion is probably more important than mine. But what I look for, my rule of thumb, and this is what I've learned from Kevin too, specifically column J, return to drawdown. I think we can both agree this is arguably the most important thing to look at and what we base our rules off. I like to see, I think, which is the same as yours, Kevin, greater than 2 return to drawdown for me to say, hey, okay, I want to run this strategy now, at least in incubation in my paper or sim account, right? Now before, I know it passed because I ran this before this video, but that was only with a slippage of 2, right?
Right.
We did 3 and look how much the results dropped, right? Of course they're going to drop. It's going to, it's more slippage per trade. And now if this is the first time, I would not run this strategy. I'd be like, okay, next idea, right? Because, nothing was above 2, none, no starting equity. Now, Kevin, I know that you also have a rule between 1.5 and 2 that you'll just run it in incubation longer too, correct?
Mm-hmm.
Yeah.
Right. And, part of the reason too, it's that slippage, the additional slippage. It might also have to do with the starting equity or the stop trading equity. If you had that lower, that could affect it too. So sometimes I've seen it, especially with the margins now going up, the past few months, that some strategies that might have passed previously don't because of that increased margin requirement. And again, people have to realize this is all just kind of an estimate. You're using the margin that's required today.
Yes.
6 months from now, let's say volatility goes away, the margins will go back to 10,000. And, the one thing this Monte Carlo doesn't do is account for margin change through time.
Yes.
And I kind of wish it did, but I have never found that data. Maybe the CME has it buried somewhere, but what you'd be looking for is like the daily data for the past 20 years of what the margin requirement was every day.
Yeah.
So without that, this becomes still a great tool, but people have to realize that sometimes it has to make certain assumptions just because of what we have data wise to deal with.
Yeah, that's actually a good point. So yeah, Kevin, I think you've destroyed my strategy. I'm not going to run it. I mean, I ran it today, I made money, but like obviously that just, a very small sample size one day. Who cares about that? But yeah, I would, if I'm looking at this return or drawdown here, I'd be like, nope, don't like it. Moving on, new idea, new strategy. So yeah,
So I'll tell you what a lot of people do at this point.
Go for it.
So they'll go back and look at the year by year results and they'll say, those first 4 or 5 years really didn't do much. What if I just excluded those because those are 10 years ago, 15 years ago, I'm just going to get rid of them. And you run it again and it'll probably pass because you'll be on that incline of your hockey stick equity curve, right?
Yep.
So for people thinking of doing that and thinking that's legitimate, what I always tell people, tell students all the time, say, if those results, okay, you're eliminating those 5 years because it's old. Okay, I get it. Okay. If those results had been good, would you have eliminated them? And if the answer is no, then why are you eliminating them because they were bad? You know what I mean? You can't have it both ways.
That's right.
So that's a really common mistake that people will just dismiss data. Or I've had people, and myself included, where I wanted to test to 2007 and I accidentally back tested to 1997. I was off 10 years, and those first 10 years made this where the strategy was awful. I said, well, I didn't even want to test that, but I should just dismiss it. But now you see the results and you can't make a decision and say, well, I'm just going to dismiss it. So watch out for that, because that's just one of the, there's probably 100 different ways that these back tests, walk forward back tests, whatever it is, can really screw with you. And that's just one of the ways. And I've done it. I don't do it anymore, but I have done exactly that, where I've eliminated data that I didn't like.
And the other thing too is, so if you do that, or the next thing I'm going to tell you, we're going to be calling the police on you because it should be illegal. But one thing I've done, Kevin, too, is, run the walk forward. The results aren't that great,
all right, let's go in here and let's change my stop loss. Maybe let's try,
Yeah.
1250 to 2000. And whoa, it does a lot better. Great, let's use it. That's a huge no-no, guys. You can't change the walk forward after you run it, because now what do we do, Kevin? We're essentially now overfitting from 2008 until now, right?
Right. Right.
And
So
yeah, go
yeah,
ahead.
it's not 100% out of sample. Maybe that first time you retested it now is 95% out of sample, like, and then you do another tweak and then it's 80%. And pretty soon you do enough tweaks and your walk forward is meaningless. So that's a real common one too, because I know this strategy is pretty simple, but let's just say you spent weeks developing this idea and thinking about it. How do I get these Bollinger Bands to work? And what ends up happening is your emotions, your mental state, your ego gets sucked into this strategy and you want it to pass. I mean,
Yeah,
that's just natural, right?
yeah,
And you'll do anything you can to make it pass. And running the walk forward multiple times is another very common thing that people do. And um, I've almost never seen it really work out. It'll work out on some strategies, but most of the time it
yeah.
won't.
And that's luck. That's luck too, right? Like, you know, you can go back and alter your walk forward, which is increasing your chances of overfitting your strategy. But we're saying increasing chances. Yes, you could, maybe get lucky and, you optimize, overfit your strategy, but you've overfit it to say the bullish side. And the day you run it, markets start trending up in your favor and you make some money and you think that you've solved the market, but it could be luck with that too, right? So,
Right,
um,
right.
the goal is to maximize your chance or minimize your chances of overfitting. And to do that, you only run the walk forward once. You use tools like the Monte Carlo to reduce that chance of overfitting. And then one thing we haven't shown is obviously incubating the strategy, where you run it in a simulated or paper environment for an extended period of time. Kevin, I believe you like anywhere from 6 to 9 months, to give it some time to see how it does. Personally, what I do is when we were talking this before a call, I do run it live the next day in with micros, which take a lot less capital than trading the minis. This won't work for everyone because obviously you need enough capital to take those small dollar losses, right? And not everyone has that. I understand that. If you only have $2,000 or $5,000, uh, definitely don't do that. Run it in a paper account for an extended period of time. But I can afford to run it in micros, and even if it doesn't do that well, you know, I may end up losing a couple $100 a month or whatever, which is fine. If it does do well, then I do benefit from that. But
Mhm.
do run it with either ideally in a paper account or a really low capital required instrument, and see how it performs over a period of time. And then if it does well, then maybe you can up the size or go from a paper to a live account. If it can continue to perform in that real type environment. So that'd be the next step after this Monte Carlo test. But Kevin, I mean, yeah, didn't pass. So I think a lot of people watching wanted to see it pass and to see us jump for joy and say, hey. But no, this is part of the process, guys. I mean, I would say this week alone, Kevin, I've tested probably I would say anywhere from, I don't know, 8 to 10 strategies,
Mhm.
and one has passed, right?
Yeah,
And the other 8 or the other 7 just failed, including this one, right? So and that's part of the process, and that's something you have to accept, and that's a reality, right? Um,
yeah. And
so
actually, your percentage passing is pretty good because depending on how you test, let's say you decide, hey, I'm going to test this strategy on 50 different markets and 5 different bar sizes. So let's say you're running 250 tests. A lot of times you'll be lucky if you even get one of
yep.
those to be something decent. So I've I used to say, hey, you probably need about 100 to 200 tests before you get something good. Um, and if you do more markets, it's more like one out of 1,000 maybe. And
Yeah.
so then what you really need as part of this, uh, is some way to automate a lot of the testing, because to do what you've just done over and over and over again,
Yep.
and TradeStation's the same way. You pull up a chart, you insert the chart or insert the strategy in the chart, run the optimization. That takes a lot of time.
Yep.
And yeah, it's hard to test a lot of things that way, but
yeah. So anyways, ton of value in this video, guys. I hope you learned a lot. Overall, once again, as I said in the beginning of the video, intraday strategies are tough, like very tough. You're rarely going to find a good one. And what I found too is like the ones that are good, they don't trade very often. It's very hard to find an intraday system that trades every day and that passes all of these really robust tests. You will find more success with swing trading systems. I have experience, and I'm sure Kevin has experience with that too, for sure. But
Yep.
I hope you found value in this and being able to see what it takes to test strategies, to put them through the gauntlet, because our goal is to beat them down. We want to make sure they're robust enough that when we run them live, our confidence is at the highest, right? Because you have
Yeah.
no confidence and you're doubting your strategies. It's so hard. It's so hard, Kevin, to like, if you have no confidence to keep going, right? But once you have confidence and you run walk forward, like tools like walk forward and Monte Carlo, it just feels better. And when you start winning, when those systems, do well, which there's no guarantee, but when they start doing well, it just pushes you to keep going. So,
yeah, it kind of becomes a spiral upwards. Is you don't have confidence, but then you see some good results, then you
Yeah.
have a little confidence, then you want to build more, and it just keeps going up. But the tricky part about it is it's not a straight line. It's always ups and downs. There's always going to be good luck and bad luck, and the bad luck always shows up in real trading. So
Yep.
I always liken it to, think if you were the house in a casino. You might not make money every single minute of the day, but I bet you make money every day,
Mhm.
or every week and every month. The odds are in your favor, and that's what, when you back test correctly and you build strategies correctly, you're just tilting the odds in your favor. Doesn't mean you're going to win every day, week, month. I've certainly had losing months,
Mhm.
extended periods of losing, but eventually things kind of come around.
Yeah. Appreciate it, Kevin. Well, thank you so much for your time. In the description below, guys, you can find Kevin's Monte Carlo sheet and his website and his strategy factory course, which I would definitely recommend. Tons of good knowledge. I've taken it personally, and it's helped me become a better automated trader. So appreciate your time, Kevin, and hope you guys found value in this. Let us know in the comments below if you want to see more videos of me and Kevin. I think we have one more planned so far, Kevin, but if people like us enough, then maybe we'll do some more in the future.
Oh, absolutely.
After
Got to
that.
see
So,
comments though.
yeah,
And
we need
likes.
comments. I need,
Comments and likes.
I think, yeah, I need 10 comments, guys, because I think I've been under 10 for a while. So let's see 10 comments and we'll make some more videos
There you
together.
go.
Kevin, I appreciate it. Thank you, man.
All right. Thanks, Jacob.
Peace, guys. Okay.